Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in lovely Greenville, South Carolina. I'm your host, as always, Stan McCune, realtor right here in the Greenville area. And as always, you can find all of my contact information in the show notes if you need to reach out to me for any of your real estate needs. And just a reminder, as always, if you enjoy the show, please subscribe. Make sure that you don't miss any future episodes. Please go ahead and hit that little 5-star rating. Leave a short little review, and I would appreciate all of that. That's all that I ask from you guys, that and that you give me some real estate business at some point. I'd appreciate that as well. It's always a good thing. But that's it. Please leave a 5-star rating and a little review and subscribe, and then we are good to go. Today is a very special day. I've been trying to do this, or I've been trying to build up for this for a long time, to finally have a guest on the show. And so I'm very excited to do this. I'm also doing a video of this. Now, we'll have to see. I'm trying to do multiple things at once that I've never done before. So we'll see if I end up moving forward with the video. But regardless, I have today a very special guest, Derek Horton, who is a senior vice president and mortgage executive at Southern First. And Derek and I got connected very early on in my personal real estate career. He's handled since that time every personal mortgage that I've gotten, as well as a huge percentage of my clients' loans over the years. And we've had battles with appraisers, we've had battles with underwriters, battles with unreasonable sellers, the whole gamut. But I can say genuinely that Derek has legitimately gotten deals done for me over the years that I don't think any other mortgage executive, loan officer would have been able to do. And I think that that is really the highest praise that a realtor can ever give to someone in the mortgage space. So Derek, welcome to the show. Thank you for coming on. Thank you for all the work you've done over the years. And welcome.
Man, thank you. Thank you. That's a great introduction. I'll take it.
Yeah,
you're right. If a realtor can endorse you, that's as good as it gets.
Yeah, absolutely. So,
thank you for having me on.
Yeah, you're very welcome. I couldn't think of anyone who I'd rather have as my first guest on the show. Nice. Just with all of the stories that we could tell, and I don't know if we'll tell. I don't know if we'll tell any of the juicy ones, but we could. We could do that all day.
Yeah.
Maybe you'll come back on the show and we'll have to do that another time. But I want to start with this. A lot of people these days, they just want to Google mortgage lenders and they're just looking up, what's the cheapest rate that they can get, or what's a lender that they can get that just has a little chat feature that I can just upload things online. I don't have to talk to anyone. That's what a lot of people are wanting to do these days, or they think that that's what they want to do. And I talked on the show in the past about why I think it's important to go with a local lender and a local loan officer. But I'd like for you to just take a moment to give your elevator pitch from your perspective as a loan officer, someone who's been doing this for years. What is it from your perspective that is the thing that separates a local lender, local loan officer from one of these internet, iBrokerage companies that does lending?
Yeah, I think the number one thing I would say, and it just happened recently, and I won't name the company, but a client came to me after they were in the middle of a transaction, 2 weeks away from closing. They had an online lender that they had found, and they ran into a little bit of a hiccup, and the online lender became unresponsive for like a week. So didn't hear from them. They couldn't get them. The realtor couldn't get them. No one could get them.
Imagine that.
So, yeah. And so they end up calling me. We end up jumping in. We have to get the transaction to closing. And I say all that to say the number one reason I think is because generally speaking, the local loan officer has tons of relationships that matter to them. They care deeply about the particular realtor that that is involved in the transaction. And generally speaking, they care about the client that they're going to have to look in the eye at some point because they're local and they run into them or they see them at the closing table. So I think ultimately they care a little bit more. They're not just a person behind a telephone or a computer that never interacts really with the client. So ultimately, I think that's the key, right? Is that they have skin in the game themselves, and so that makes all the difference in the world in getting the loan to the finish line.
Yeah, absolutely. And I think as well, one thing that I didn't really understand when I broke into this industry that I understand a lot more now is how a local lender, you guys have relationships with the underwriters, with the appraisers, and there's just accountability kind of across the board that you
Yeah.
just don't. I've had closings with Rocket Mortgage and Quicken Loans and whatnot over the years. They just don't have those relationships, and so when the what hits the fan, um,
Yeah.
they're not going to be able to step in and save the day. We're kind of at the whim of all these other parties.
Yeah, I would echo that. So when I was getting into the mortgage business and I was interviewing, I interviewed with a ton of companies because I was trying to find the best place. And another lender who had been in the business a long time said, wherever you go, make sure you can see the underwriter. Make sure you know the processor. Make sure that you have a relationship with them. And it's true. So if I have a problem with a loan, I can literally go talk to the underwriter down the hall, and it is much harder for an underwriter to just. It's much easier for an underwriter in Idaho to check a box, decline a loan, move on if they don't have to interact with me on a daily basis. There's accountability there that you just don't have when they're distant, and so I think a local lender has the relationships around them that really can make or break the transaction. It's such a dicey. We talked about this, you and I. There's so many things that can go wrong, and so if you have a local lender and a local realtor who have relationships, they can help navigate all those problems versus someone that you don't know. You tried to list yourself or you tried to buy without an agent. I mean, there's just whatever it is, having the right people around you will make all the difference in the world.
Yeah, absolutely. So, a lot of people, and honestly, I kind of put myself in this category as well. Like, we don't necessarily know what your day to day looks like. Like, as a loan officer, mortgage executive, walk us through like what's a day for you, kind of a standard day look like.
Yeah, so we work, generally speaking, we work flexible schedules like you do because you know if I'm here, I may not be as busy on a Tuesday as I
I
am
don't even work. What are you? No, I'm just
as I
kidding.
am on a Friday because listings come out on Thursday or whenever, and then all of a sudden all these people want to see this house and they need a pre-approval. So our schedules vary. We pretty much work. We're on call all the time. On a day, just a typical day, for example, this morning I got up. I got to the office at like 8:15. It's a little bit busier than normal with applications, so we had about 8 pre-approvals we had to get done this morning. I did, and so most of my day this morning was spent pulling credit, reviewing the financials clients had uploaded, and sending out pre-approvals. Most of them, and trying to work through issues that the clients had, right? And so that's a big part of the day when you have a lot of applications. So I would say getting applications and then reviewing those is a big part of the day. Once the loan is written, another big part of the day is getting all of the extra financial documents that the underwriter has requested before the loan can
Oh
close.
yeah.
So that's a big portion of the day. And then following up phone calls. Being a loan officer is a sales position, and so you spend a lot of time in those details of the actual loans you're working on. But then if you don't dedicate a large part of your day to building relationships with financial advisors and realtors and other bankers and whoever, then you're not going to have any business the next month. And so it's a balance constantly of not getting too caught up in the weeds of one particular loan, and trusting the people in the back office to do their job, which is not easy to do because there's a lot riding on it. And then also balancing the sales side, which is building relationships out in the market. So I would say a good loan officer is working long days, especially in the spring and fall. It's not it's like real estate. You're on call all the time, and there's always problems. And so that's what you're dealing with. You're kind of a problem solver overall. And so I think that's, I always say the best loan officers manage the chaos for the client and the realtor to an extent, right? Those are the best.
Yeah,
They
absolutely.
they take all the anxiety and pressure of the transaction, and they absorb as much of it as possible so that other people, their client particularly, don't have to kind of deal with it.
Yeah, absolutely. Now, one thing that kind of piqued my interest, you mentioned an uptick in mortgage applications. Is that just a random thing, or is that something that you're kind of seeing and others are seeing right now?
I don't really know. Honestly, I've just saw all the data that said mortgage applications are down.
So did I.
About that. And so, but since last Tuesday, for whatever reason, I have seen me personally, and I haven't really checked with a lot of the other bankers, but I've personally seen an uptick in applications. So I don't know if it's just an anomaly, but
we'll have to keep track of that.
I know. I'll take it.
Yeah, absolutely. So one thing I was thinking about is I was kind of thinking through some of the questions I wanted to ask you, and a lot of these questions are, I'm not like fishing for anything. I'm like legitimately, yeah. I want to actually hear what you have to say. So what's something that you know now about real estate or the mortgage industry that you wish you knew earlier in life or earlier in your career?
Yeah, that's a good point. So I think what's something that I wish I knew. I think I wish I would have known. For me personally, I wish I would have known how much easier it was to get a home loan than I thought it was going to be. For me personally, in the beginning. So I did not have a lot of money at 23, 24 years old. I was, kind of throwing money away, with how I was living, and eventually I started to get married around 25, and I did not want my wife living in where I was living. And so sure. I started looking into it and realized like there's options out there, and where I didn't have to have a ton of money to put down, And so I was able to buy my house using a USDA program, which is no money down, when I was 25, which was, 20 years ago. And so I think
what part of was that in the upstate?
Yeah, it was in Duncan.
In Duncan. Okay.
Yep. And so I was able to, I think so looking back, I would have just started maybe trying to buy a house earlier, because I didn't think it was possible for me. I actually grew up in a single wide trailer. We upgraded to a double wide. And I was one of the first people in my family to ever own a house. And so it just wasn't in my realm really. And had it not been for my wife's family, I don't even know if I would have pursued it. They're like, you got a good job. You should just go talk to a loan officer, And so I think for people out there, I think that just take the first step, reach out to a realtor, reach out to me or a loan officer, any local loan officer, and just at least have a conversation. It doesn't hurt to do that.
How much longer was it after you bought that first house that you got into the mortgage business?
So interesting story. So I was 25. I did not get into banking until I was 31. So I was kind of working in a call center and then doing a couple of other types of jobs. And then a friend of mine was in banking, and I didn't go straight into mortgage right away. I was kind of a personal banker and then branch manager and kind of morphed into just doing mortgage lending. But I became really interested in mortgage lending because a couple of things. Number one, the first time I ever thought I was going to buy a house, which was right around 25, the loan officer was not local and they fumbled the deal. And then I got in touch with a local lender who got me to the closing table. So
you saw the value firsthand.
I always remembered that experience. And when I decided I was going to get into mortgage, it was very meaningful to me because I remembered how much anxiety I had felt through the process. And I wanted to try to figure out a way to help my clients really through constant communication, not experience the angst that you feel during the time you're under contract to the time you close. And so that was part of me being in the mortgage business. And then how critical, I don't remember where I read it, but how critical owning a home is to our society, right? The stability of families, right? Kids not being moved around a bunch of times. My dad had moved around a ton growing up, from one house to another. Me and my parents, luckily, they rented a lot, but they did not move me around a lot, thankfully. But generally, when you rent, you move around a lot. And so home ownership gives a lot of stability to families, and it's the primary tool by which most Americans build wealth. Mm-hmm. And so I became early on in banking, realized I felt like the most important part of the financial world was being in the housing market. And so, I made sure that was kind of the path I was on.
Yeah, that's great. So over the years that you've done this, how many years is it now? I feel like we both start around the same time?
I started into mortgage full time in 2017.
So yeah, about the same time.
I was in banking. I was in banking, for 14 years or so, but in mortgage specifically. And kind of banking can be weird, right? You can do mortgages in a lot of different ways. There was a bank I was at for years where I would do mortgages, but I was a salaried employee, and I was I'd do mortgages if somebody walked in the branch, or I would refer them to a traditional mortgage person. So banks and there's all kind of ways you can get in the mortgage world. I've been full time only doing mortgages since 2017. And so, if somebody came to me for a car loan or, any other kind of loan, I can't do it. I just help people buy houses. So.
Yeah. So I got licensed in 2016, but I started doing this full time.
We met, right? Yeah, we
2017
met
as well.
We met at the beginning, kind of at our both kind of early stages of being all in on real estate. So.
Yeah. I think you were the one that reached out to me.
I think probably so. That's generally how we.
Yeah, that is generally how it happens.
We're desperate.
Well, as far as just kind of what you've seen over the years, what's typically like the most common misconception that you feel like people have when they're trying to get a mortgage? Is it that they don't is it the misconception that you had that you didn't realize that you could? Or that you could get a mortgage, or is there something else that you run into that's kind of like, okay, this is a common pitfall?
I think it falls along those lines. I think the biggest misconception is that you have to have 20% down. You have to have a lot of money.
Oh,
you have to have a lot of money. You have to have a lot of money to buy a house. And I don't know where that comes from. I do think that it is becoming less and less a misconception because of all the internet marketing out there now.
Yeah.
But I think that there was generations before us, our parents, who private mortgage insurance was astronomical. If you don't have 20% down on a property, you've got to pay an extra premium to your mortgage payment. And I think it was astronomical, and it was not worth it to buy a house in their mind.
Has PMI come down a lot in
it's come down a lot. So used to, like when my parents were buying a house and they didn't have 20% down, PMI was astronomical because there was only maybe one or two companies that offered it. Well, now there's a bunch. And it's not just that there's a bunch, it's that the technology allows all lenders to quote them all at the same time. So in a simultaneous quote. So you hit a button and every one of them will give you a premium, a price, a monthly price. And you're going to choose the lowest one for your client. Obviously, there's no incentive for you to choose a higher one. So, and so they're daily battling to get their rates as low as possible. They want to be barely the lowest. They don't want to be too low because then they're going to lose money, but they want to be right there at the threshold. So they're constantly changing. So I think people for a long time thought 20%, you have to have 20% or you're going to pay $500 a month on private mortgage insurance, which is a big misconception.
Yeah, that's interesting.
I would say that's a misconception number one, and that flows into it's not possible for me, right?
Right.
People think it's not, homeownership is not possible. I've rented my whole life. My parents have rented their whole life, and it's just not even in their sphere of being able to buy.
Well, yeah, with the median price point in Greenville being 300,000, 20% of that is 60. Plus, you've got closing costs. I run into people having misconceptions about closing costs. People will be like, "What are closing costs? Is that 15,000? Is that 20,000?" No, it's going to be way less than that typically.
It's gonna be 6,500, maybe 7,000.
Yeah.
Yeah.
Yep.
And so that alone in and of itself, I think is a big misconception. So it can be much more possible to buy a house than people think.
What about on credit? Are there any misconceptions that you frequently run into, or is there like one big misconception you frequently run into with people about their credit or about building credit or just about credit scores in general?
Yeah, I mean, I would say a big misconception is that number one, my credit is on two fronts. My credit is too low, right? People think their credit's too low, and sometimes it is, but that doesn't mean you're not going to be able to buy a house. It just means that you got to find a loan officer, not online, because they're not going to help you, but a local loan officer most of the time values the relationship of whoever sent them your way, and they're going to work with you to try to figure out, if you've got a 580 credit score, how to get you to a threshold where you can do something, right?
What's the lowest that you can think of that someone came to you, the lowest credit that they had, that at some point they closed out a loan with you?
I think the lowest for me is 600. So you can get FHA loans down to 580. We generally try to keep them. We try to get someone to 600 because of the price, the rate hit that you take when you get under 600. And so if somebody's at 585, we'll say, hey, let's take 60 days, do a few things, try to get your score up.
What's the lowest though that someone came to you? They started. What was their starting point, and then you got them up to
low fives, 515, 520.
How long would it take for them to get up to 600 typically?
Well, I have a client now who's buying a house. She has rented this particular house for 15 years. Okay, crazy. She's rented this house she's buying for 15 years. She probably came, I can't remember exactly, 560 or so. It took her to get it up 100 points. The particular program we wanted to use required a 660 credit score. So it probably took her about a year, maybe slightly over, to get her score up. But she got it up. She's going to close in like 2 weeks, maybe a week. She's ready for closing.
Yeah.
And she's been renting this house for 15 years, which is cool. She's never owned a house. I don't think anybody in her family has. So I'm super excited about her buying a house. And so if you find a loan officer that's willing to kind of stick with you and you do the things that they tell you to do and be disciplined, you can buy a house.
Yeah. 100%. Yeah. And it's extremely rewarding to see that, see people, taking steps towards breaking the poverty cycle, that's in some cases has been a generational cycle, starting to kind of finally have the family has their own dirt, and their own house. And that's an exciting thing.
Man, it's so exciting. Another misconception that I think is a big one that I run into a lot is I pay $1,500 a month for my rent. Why can I only get pre-approved for an $1,100 payment? And so I have to do a lot of talking to clients and say, listen, when you go to an apartment complex, they're going to check your credit. They might ask for a pay stub, but they're not doing any kind of like calculation as to what you can afford, right? They're just checking your credit. You got decent credit, you'll probably pay us. They're going to take a security deposit and they're done. When you buy a house, an underwriter is going to look at your credit. They're going to look at all those payments. If you have a $400 car payment and you have a $200 student loan payment and a $100 credit card payment, and then you're going to buy a house and your mortgage payment's $1,100, they're going to take that $1,100 and they're going to add up all those other debts, and they're going to go, oh man, that's going to be more than 50% of their income if we give them this loan. they can't pay a $1,500 payment. They can only pay a $800 payment or whatever. So I think helping people understand, like, hey, just because you're paying that much in rent doesn't mean necessarily you're going to be able to buy a house
Sure.
comfortably. There's a lot more expenses that come with owning a home, right? There's maintenance, there's taxes, insurance, other things. So I think helping people understand, and I do that constantly. I send them like a big breakdown of all the numbers, and when they see it on paper, they go, "Oh, yeah, I see that now. That makes sense."
Yeah, and it makes sense too that if you're a landlord or a landlady renting out a property, it's only going to tie up a property for a couple of months, at least in South Carolina. If you have to call someone that isn't paying you and ultimately evict them, whereas if someone forecloses, that's a lengthy process. So it makes sense that it's more stringent.
Yeah, it's more stringent, and I think just helping people understand that, and there's a lot of times it's the opposite. I tell people, hey, you can qualify up to this amount, and they're like, what? You would give me a loan for that amount? I'm like, yeah, I'm not telling you to go buy that house. I'm just telling you what you can qualify for and what you can afford are sometimes two different things,
Yeah. Yep. Yeah. Oh, I've run into that so many times where people come to me and they're just like, Derek pre-qualified me for $550,000 from my first house. Like, how's that? And I'm like, well, that doesn't mean that you have to buy that. It just means that we're in good shape.
I try to tell people that all the time. Listen, don't, you may have a lot of room, but you don't want your house to be a burden, right? You want it to be an asset that helps you grow wealth over time and provides, financial stability. So you don't want it to be a burden. So I tell people this is what you can buy, but I'm not saying you should buy that. So
yeah, absolutely. Similar thing to what realtors have to say a lot.
Yeah.
Speaking of realtors, I am curious to hear, kind of shifting gears here a little bit. You guys on your side, you see us as realtors from a little bit of a different perspective than maybe the public do. You see kind of a little bit behind the veil. We see a little bit behind the veil of what you guys are doing as well, probably a lot behind the veil. I'm sure there's a lot more that we don't see. But I'm curious from your perspective as a person, having worked in banking and the mortgage industry for as long as you have, what would you say separates an average realtor from a really good one or a great one?
Yeah. So, I mean, obviously I do have a lot of thoughts about that, and people do come to mind.
Yeah, no doubt.
I would say what surprises me a lot of times is the lack of just basic knowledge sometimes amongst some realtors when I call about an issue or a problem, and I'm like, how are you able to advise? I see myself as kind of an advisor. I think a realtor is somewhat of an advisor. They are sales positions, but they are an advisory role. You're giving advice a lot of times. And so I'm always surprised by some of the things that people don't know, some of the things that realtors don't know. I'm ultimately not as bothered by that as I'm bothered by poor communication. And so I think the biggest difference between you and some of your peers is your ability to communicate and just answer your text, answer your phone, answer an email. It's not rocket science. It's just staying in touch with the lender, your clients, the attorney, whoever else. But I think the biggest frustration for me is the lack of consistent communication through a loan, or through a purchase. So I get very frustrated by that when I don't get responses. I am very frustrated.
Is this where the swear words that you warned me about that I might have to edit out might come into play?
I could drop swear words in here. What really frustrated me recently, and I posted about this, I said on Twitter, "Good morning to everyone except the realtor who told me to call their transaction coordinator." And so I cannot, I generally tend to think of, when I'm working on a transaction, you've got a buyer's agent, a seller's agent, and my client. And those are the people I interact with the most. Most of the time, the buyer's agent and my client, occasionally the seller's agent. So when I call when I think of who do I need to call about this problem, the first person I think of is the buyer's agent. And then the buyer's agent tells me, no, I'm no longer involved. Call this person. It just blows my mind that, they have just pulled themselves out of the transaction. I just don't understand it, because I think one of the things that separates our model here at Southern First from other models is we don't hand our clients off, and we get more clients to the closing table than most lenders because we stay involved. We don't pass them off to people. So I think the realtors that I work with that are most successful and that are really good at their job, I'm not saying they don't have help, but they don't pass responsibility off for their clients and that transaction to anyone else. They stay accountable through the whole process.
Yeah. And, oh man, we could talk about this for forever, because obviously, if I'm a buyer's agent, or a listing agent, and I'm, dealing on the other side with another agent that is essentially, they only see themselves as a salesperson, and then once we're under contract, that they just pass everything off to their assistant or their transaction coordinator, who's not licensed. In many cases, even if they are licensed, they don't have all those relationships. They're kind of jumping in. It's incredibly frustrating. A lot of times the transaction coordinators don't answer phones after hours. Have you run into that as often as I have?
1,000%. Yeah.
So,
or I don't have the cell. I just have some other number that I text and it says it's a landline, and I'm like,
yeah,
gotta talk to somebody.
Unbelievable. And probably the worst part about this is that we, just as far as what me and you, like, we all know this, that these are issues, but nobody can actually say anything about the companies or the teams or whatever that are known for doing this. There are some that have a reputation for this, but unfortunately, it's very difficult for the public to find that out. They have to kind of find it out the hard way, because we can't talk badly about any of those groups. So,
and I would just say the top realtors in the market, they don't follow that model. I mean, I know them, and they stay very active with their clients through the whole process, and they answer their phones and they answer their emails, and they're busy. So I just think, I think being educated, which is the same as a lender, being educated, knowing your products, knowing how you can help people, and being able to communicate well as a realtor, I think, and valuing communication really separates people. And I think when I say communicating, I mean, if you're not communicating, I don't think you care very much. And so I think the good realtors, ultimately, what separates them is that they really, really care. And they really want that client to get that particular house, and not anything to, destroy the transaction, because they're not doing their job well. So
yeah, absolutely. Same thing for loan officers as well.
It's the same. Yeah, it's so it is different, but they mirror so closely what success could look like, and what separates the good from the bad. There's a lot more of you guys, which makes it probably harder for you to do your job.
Sure.
But I still think there's a lot of similarities.
Yeah, I think one of the most important things for me that I've done from day one, and this was kind of instilled in me from previous job experience, was I don't ever think about my paycheck until I get my paycheck. That's when I think about it.
Yeah.
Because if you're focused on your paycheck, you're not going to have the client's best interest in mind at the end of the day.
Yeah.
And unfortunately, talking to other real estate professionals, there's a lot of paycheck focus. That is unfortunate.
Meaning, let's just get this done. Don't worry about what's best. Let's just figure out this situation, and it might not benefit either party, or it might benefit one or the other, but let's just get it done.
Yeah, exactly. I listed this house. I mean, I know I know he could probably get more for it than what we've listed it for, but oh well, this is, he did it this way. This is gonna be a quick closing for me, kind of thing. And it's just like, you didn't say that the person was leaving money on the table. It's just kind of astonishing to me. But those conversations happen, and it's unfortunate.
Yeah.
So obviously right now, shifting gears again here for just a moment, and this will kind of be the last little section here, because I know you're busy and I'm busy, and we could talk for forever.
Oh,
Obviously what everyone wants to hear, and what they're going to be most interested in hearing from you, is about what's happening in the mortgage industry as a whole. We've gone from rates at an all-time low when they were in, the 30-year mortgage. What was the lowest rate you did for a 30-year mortgage the past couple of years?
lowest 30-year was 2.375.
2.375. Oh my gosh.
No points.
No
fee.
points. Unbelievable.
The lowest 15. No, I did a 10-year at 175.
That's
so
insane.
10-year, and I did a 15-year at probably 2% or so, I guess. But yeah, 175 or so to 2375. Which
when was that 2375? What do you remember? Kind of month, year, or roughly?
Gosh, I want to say maybe early 2020, maybe.
It would have been early 21, right? Because early 2020 would have been pre-pandemic.
Yeah, early 2021 probably.
Okay.
Yeah, that's right. That's right. So because early 2020 was, we heard it was coming, but we're like, we're good. Yeah, so either late 2020 or early 2021, it was just, I remember looking at the rate. I remember logging out of my system. The reason I remember the rate so well is I remember logging out of my system because I thought something was wrong. I logged out because there's been times that, something doesn't update right and you get an error, and I was like, there's no way it's 30 years, 2.375. And I remember logging out, logging back in, and I called another lender who works in the office beside me. I was like, come look at this. And we looked, and I'm like, I locked this person in at 2.375. And I remember locking it in, normally you call the client, you tell them, hey, here's what we can offer you. I just locked it in. I was like, whoever, they're gonna do this because
that's incredible.
So I locked it in before I even told the client. And it's just insane how low they were. And it was, I don't even know how I survived mentally and physically during that time period, because of the hours we were working. But
you and me both.
It did switch very fast when it switched.
It did. So now what are we hovering around, like 7%? We're kind of in that range, just on an average level.
Yeah, I would say 6.875 to 7.125 right now, on the 30-year fixed. The crazy thing is 4 weeks ago.
And for the audience, we're recording this on March the 8th, 2023, just for receipt keeping.
Yeah, and so a month ago, those rates were back in the low or high fives again, and so people were back on the internet saying, we hit the peak, we're back down. And then the jobs report came out, and then the inflation report was not as slow as they had liked it, I think, and we were back at 7% very, very quickly. And it's been rocky because you pre-approve people at 6%, and now they're at 6.875.
Yeah.
And that lowers their purchasing power. The market is still if you're, wherever you're listening, Greenville is still a hot market. And so, house prices are higher and rates do not allow that buying power that people need. So
are there any rumblings that, like, assumable mortgages will start to become, kind of come back in vogue here in the next few years? Is that something that anyone's talking about yet?
Yeah, I mean, I hear a lot. There's a lot of lenders that talk about assumable mortgages online. It's less likely because basically what happens is there's only a few types of loans that are usually assumable, right? FHA, some VA, and maybe some bank portfolio loans depending on the situation. Most of the time, if that client has bought a house and it's been a couple of years, their house price has appreciated so much compared to their loan. And also they may have paid down their loan a little bit. And so there's a lot of times people don't have the money to make up the gap to get that loan, to just assume if the house is worth 300 and that person has a $220,000 mortgage, they don't have the money to get, that they need.
The buyer would have to in that instance would have to bring $80,000 down, and then they would be able to purchase it at 300 and assume 220.
Yeah. And they'll be able to get the 2.375 rate or whatever it happens to be. So I don't think, in theory, it's great, but I don't think it'll happen a whole lot.
Sure.
Yeah.
So obviously a lot just in real estate as a whole has changed pretty dramatically since the pandemic, obviously, since we're now going on close to 3 years, I guess. Here we're approaching that anniversary of when lockdown started, and I'm just kind of curious, what's the biggest difference in your opinion in the mortgage industry the past 3 years, and more so, recently versus what it was pre-pandemic?
Yeah. So during late 2021, mortgage rates were, I think December 18th, I think I locked in a rate at 3.375. I think by May or June of 2022, so 6 months later, the rates were at like 5.5 or 5.25. So, I mean, that's massively slowed the mortgage market. And so loan officers went from being extremely busy to, honestly, a lot of peers have moved. They've started moving to other jobs because there's just not enough buyers. That the business that was there is gone because there's no refinances, and a lot of lenders specialize in refinances. Well, when somebody's got a 3% rate, they're not going to refinance, and likely they're not going to want to move either for a while. So it's just changed the dynamic, and it changed it so fast. It's like it was just like whiplash. You went from a full days being extremely busy to trying to figure out what you were going to do, and I made this joke one time about online. I had this little voiceover thing, and it was about it was like builders calling lenders again because builders slowed. They had all these inventory and they needed buyers.
Well, yeah, they've been offering us commissions again.
All of a sudden, we love realtors.
Yeah.
So that's how drastically it's changed. And even lenders, I'm sure you get bothered, I'm sure it ramped up on your end where you start getting now all these lenders come out of the woodwork wanting to maybe get business, trying to get.
Oh yeah. I get texts every week.
Yeah. So I think it's just drastically changed things. I am very, I did not think we were when it hit 5.875. I posted a lot of videos online. I did not talk. I refrained from talking, hey, rates are low, they're down, because I felt like we were in a nice sweet spot, but it was not going to be it was like, it's like you're like, oh, it's warming up, it's spring, and then all of a sudden it's 20 degrees again. So I felt like we were going to hit that, and we kind of did. I didn't think they would be back at 7%. I thought maybe 6.5.
Yeah, I don't think anyone thought that. Not right now.
No, 6.75, but I've been shocked by that. Mortgage applications are up for me, but I think that might be because people got word that rates had come down a little bit, and some of them didn't realize rates were back where they are until they did the pre-approval. So I'm interested to see how this plays out over the next few months and seeing what the Fed does March 21st, or I think that's when they meet again. I think the mortgage market has priced in their next rate hike already, anticipating maybe a 25 at least, maybe 50 basis point hike. So hopefully we won't see.
Can you explain that for our clients? Just kind of for a lot of the people that are listening, I think I said clients, I meant listeners. A lot of the people listening or potentially watching, if I post this on YouTube or whatever, they're going to already kind of know what causes interest rates and mortgage rates to fluctuate. But and I've talked about it a little bit on the show, but do you want to kind of explain from your perspective what you see happening, how those rates go up and down?
Yeah. So, I mean, generally speaking, mortgage rates are not supposed to follow what the Federal Reserve is doing with short-term rates. Okay. They're just not supposed to. So when the Fed's raising prime, mortgage rates are supposed to be kind of, separate from that. But I think what's happened is the Fed has raised them short-term rates so fast, which is the Wall Street Journal prime, from what was it at zero? I mean, it was zero at one point, I think, in the lowest part to what it is now. The Wall Street Journal prime, I think, is 7.75. And so, I mean, I think that the mortgage market is so uncertain as to what it's going to do to the economy that they are pricing in the risk in mortgage rates. They don't know. So if you're a bank, for example, let's just say you're a person and you own a bank and you see the Fed take rates and just attach a rocket to them and shoot it into space. At some point, it's going to cause not maybe drastic, but significant unemployment. When people get unemployed, they stop paying their bills. Now, the mortgage is generally the last thing that they stop paying, but if it lasts long enough, they stop paying their mortgage. So if you are anticipating people not being able to pay their bills, you
need to get a little bit more upfront, maybe.
You're expecting, it's high risk. And so the only way you can make money in a high risk situation is to have higher interest rates. And so our mortgage rates should not be as high as they are when you look at the 10-year Treasury, which is what mortgage rates are supposed to follow. They should be in the high 5% range. But banks and brokers and lenders across the country are like, they can't keep raising rates and it not cause massive economic slowdown, which in turn causes people not to pay their bills. And so that's what's going on. It's just risk being priced into the market. So
what's your prediction? And the listeners like bold predictions, so don't be scared to be wrong. I've made some bold predictions. I've been wrong on a few of them, but what would be if you had to make a prediction for what's going to happen with rates, whether we're at the ceiling or whether it's gonna continue to go up, or whether we're going to see them go down at by a certain time period? What are you kind of thinking is going to happen here?
Bold predictions. I will. Let me just preface this that I am very good at underwriting guidelines. I'm terrible at predicting the market. So
okay.
I am as dumb as they come when it comes to trying to figure out what my stock portfolio is going to do and what mortgage rates are going to do.
Fair.
But I would say most of what I read, I do think that they will soften later in the year. I do think
later in 2023.
Later in 2023, I think we'll see some softening. I think we'll see more softening in 2024. I think that, you've probably read this too, that a lot of what's driving inflation is housing,
yeah.
is, the house prices and the real estate market. And so the Fed knows that by continually to pump rates up, they can impact that drastically, right?
Yeah.
They're pricing borrowers out of the market, especially first-time home buyers, and they're pricing a lot of people out, which means they can let inventory catch up a little. I don't know if it'll catch up fully, but catch up a little, which will slow kind of the inflation numbers. So I think we may see a little bit higher rates from where we are now. I I have never thought they would hit 8%, and I still don't think they will. But I still think we could see maybe mid to high sevens.
Okay.
And
Like
then
this summer, is that kind of when you would anticipate that happening?
late spring, maybe late
Okay.
spring. So and then maybe some pullback beginning slowly from there. And I think I don't know if we'll ever. I mean, maybe ever is a hard word, but I think if we can get rates into the 5% range, 5 to 6%, we could have a healthy housing market there and stay there for a while. I don't think we have to have 3% rates again. I think that was very unhealthy. It was very good for a lot of people, but ultimately,
it's good for you guys.
Yeah, ultimately, I think if you think about someone driving a car, COVID happened and the Fed pulled the car to one side, all the way to one side, and rates were low, and now they're trying to correct. And some people say, well, they're overcorrecting. I don't know if they are, but ultimately, if they can just get the housing market and the mortgage market, get interest rates back to us, just a fair ground, which I think is in the 5% range, where a lot of people can still afford houses, but money is not 2% cheap.
Right.
I think it'll be good. So
sure. What do you think it will take for rates to come down? Like what needs to happen for those rates to start to fall? By the way, I want to mention as well, I think you're right. I went to a conference recently that said 5.25 is the magic number. Above that, dramatic slowdown. Below that, buyer activity starts to pick up a bit. So
yeah,
but what would it take for it to start to come down into that range?
I think again, I failed economics. Not didn't fail, but I did not do well in economics. Was a lot harder than I thought it would be when in school. I do think that if we get unemployment, if unemployment increases a little bit, I mean it increased a little bit, but it's still is it 4.5%? I mean, it's somewhere around there. It's still historically extreme.
Yeah, it's very low.
It's like extremely low. So if unemployment increases a little bit and they see a little bit more pullback on the inflation numbers, I don't think there's an unemployment report, I think this week. So it's interesting to see what that is. But I think once the Fed sees, like, part of me thinks maybe the Fed has not waited for some of this stuff. They have not waited for their work that they've done to catch up, right? So at some point, because they just keep going, oh, yeah, unemployment, nope, let's do it again, let's raise again. So I'm hoping that's not the case, and I'm hoping that each time they're doing it, it is impacting a little bit, and not all of a sudden we're going to have a drastic recession that's really brutal for a lot of people. I tend to think, hopefully, as the Fed sees unemployment rise a little bit and inflation come down a little bit, that they will have a couple of meetings where they don't do anything. They don't raise rates, they don't lower their short-term rates. And I think if they do that, it signals to the economy and to the markets that, all right, we think maybe inflation kind of peaked, and so now we're going to just in a holding pattern. I think if we get in a holding pattern, I think you'll start to see mortgage rates soften a good bit.
Sure. Yeah, that makes perfect sense. And yeah, I'm not super optimistic about the Fed not doing anything, but
I think in March they're going to raise. I think the last I saw, there's a 22% probability they would raise them 50 basis points. I prefer.
And if that happened, how would that impact the mortgage market?
I think the mortgage market has built most of that anticipation already in, which is why we've seen the steep climb since last time. So I don't think we'll see a big upswing leading up to March 20th or 21st. If after March, if they raise them a lot and then it looks like it's not working, then I think we could see another climb.
Sure.
Which could get us to the high sevens. But I'm hopeful that, this next meeting, we won't see what they're doing is at some point what they're doing has got to work. And so, we'll see. It's hard to know, and it's hard to run a bank. We're not a huge bank, but we're not a small bank either, but we're very close to the leadership. And so it's very difficult for a bank to manage these waters because
it's crazy.
They don't know month to month what the Fed's doing.
Is it crazier now than it was like right after the pandemic when things were so chaotic, or was that a more chaotic period of time?
No, I think it's way more stressful now for banks.
Okay,
trying to figure it out. I think they're, the cost of money, banks need, banks have to have deposits to lend. And so every time the Fed raises rates, that's why you see banks paying, like ours, paying high money market rates. Well, if you're paying 4.75 on a money market, you can't lend at 5.25.
Yeah, right.
Because you're not going to make any money. So I think it's just very stressful trying to manage, trying to know what the Fed's going to do, and so I think it's interesting times in the finance world for sure. So.
For sure. Well, we'll close with this one last question I have. What are you telling people who would like to buy a home right now, but do have concerns about those mortgage rates being so high?
Yeah, so that's a good that's really a good question. I'm not the kind of mortgage person that thinks it's right at every moment for someone to buy a house, right? There's people that have all kind of situations going on in their life. My wife dealt with health problems over the years, and there were times that we rented just because it was simply easier. We didn't have a lot of other stress. We could be near doctors, rent near doctors. And so I don't think everybody should buy. But I say this, if you are going to be a homeowner and you desire to be a homeowner, the houses in the upstate of South Carolina are not going to be any cheaper, to me, in my opinion, than they are right now. We have a massive inventory shortage. We have massive amounts of people moving into our market because it's a great place to live. And so
I heard yesterday we have 20 people per day moving into our market.
Yeah, and it was 19 a few months ago. So I've seen that stat. It's getting a little higher. So I think if you're looking to buy a house, I think you should start the conversation now with a lender and realtor, because you can always, when rates come down, you're going to be able to get a lower rate. And so that's just, you do that through a refinance. And so I think if you can buy a $350,000 house right now, that $350,000 house is going to cost you a lot more 2 years from now in the upstate. And that's just my opinion. But I don't think we're going to see massive pullback. Bankruptcies are extremely low across the whole industry. They're even lower in the upstate because unemployment is so
foreclosures are, despite some of the misleading headlines saying that foreclosures are up by 100% and all this kind of nonsense, they're still extremely low.
Yeah, so I say bankruptcies because generally that overarches too, right? It brings into the foreclosure focus. Foreclosures are, they're nothing compared to what they were. So people that say a housing crash is coming, it's not going to happen. And I think my opinion is there's a few reasons, right? Americans have way more equity than they've ever had in their houses. Americans have extremely low interest rates on their mortgage overall. Yep. Their payments are very, very reasonable, that even if they do lose their job, they may be way more likely to weather that storm and make that payment than they did in 2009 or 10. So I just think
if not, they've got enough equity they can just sell.
They've got equity to sell, and it'll buy them time to find a house, pay off other debts. And so I think people waiting for the market to crash, especially I'm sure in certain markets there's been pullback, and that may be smart to wait a little while. But if you're in the upstate of South Carolina, if you're in Charleston, if anywhere really in South Carolina, in a lot of places, Charlotte, North Carolina, Atlanta, it's just the demand is so big. I don't think you're gonna see a benefit from waiting. It's only going to cost you in the long run. So.
Yeah. And that's what I've been telling my listeners as well. So that I appreciate you reinforcing what I've been already saying on this show for months and really years at this point.
Yeah. Let me just say to your listeners too, that you, if they are thinking about buying a house or have never decided, or thinking about it, how definitely they should give you a call, because you are one of the best in the market. You care deeply about your clients. I've seen how well you communicate. I've seen your knowledge, which if they listen to you, they probably are aware that you're very knowledgeable about all things real estate. So I don't think they could find a better advocate for them than you. And so, if they're listening, they should definitely. I always think, I don't think a lender. I think a realtor is the best first call. That's just my viewpoint. I think they can have a lot of. You guys know enough about a lot of things to have a general conversation, and then you can refer that client to the person, the lender that you think best fits them. And so I think, just telling your listeners how great you are at your job, because I've seen it firsthand, and I've seen us navigate really wild situations and really difficult situations that we've been able to figure out. So, and so that takes special people, and you're certainly one of those that are really good at your job.
Well, I appreciate that. I did not pay Derek to say any of that, just for the record.
He did not.
And we as realtors, we can't get kickbacks from these lenders either. That would be illegal. So, and I intentionally said to Derek that he doesn't need to feel pressured to pump me up. So I do appreciate that you did that in spite of all of that. But Derek, I appreciate it. It's been, well, going back from before we were recording this, it's been over an hour, and your time is valuable. So I really appreciate you giving that time to me, to the show, to the listeners.
Can I give one shout out?
Yeah, go for it.
Okay, one shout out, because it's International Women's Day. All right. So we're going to give a shout out to all the ladies out there, all the women. I read this quote earlier this morning. Whatever women do, they must do twice as well as men to be thought half as good. Luckily, that's not very difficult. Shout out to all the wonderful women out there.
When this records, it'll be past that day, but we will celebrate it. Sorry, not when it records, when it airs. But we will retroactively enjoy and celebrate International Women's Day. So I appreciate that, Derek. That was Derek Horton with Southern First Bank. If you need to get his contact information, you can reach out to me. My contact information is in the show notes. As always, please, if you like this show, please subscribe. Please leave a rating, leave a review. Derek, again, thank you. I appreciate it. And to all the listeners, we will talk again next time.